Hello, everybody, and welcome to the Cyclical Investors Club YouTube channel. My name's Corey Kramer. Today, we are going to be taking a look at Celanese Corp. As you can see on the screen here from over on CNBC, the stock is down about 25% today. I checked, I haven't covered this one before on the channel, but I do track it in my spreadsheet because it's in the S&P 500. So I thought I've had some questions on it already today, so I thought I'd make a video and show you why I managed to avoid this decline today in Celanese. It's going to be similar to the Huntington Ingalls video that I just put out a couple days ago where a similar thing happened. And so this will be another example of kind of what you can, if you watch the Huntington video and then you went through your portfolio and took a close look at Celanese, you would have seen a similar issue pop up. But there are some other things going on here that I'll point out that can help you kind of some of the tricks of the trade or tricks that management like to use to make things look better than they really are. And I'll cover some of those here. So the story is, as always, this is not individual investing advice. It's just how I analyze stocks. Here's a quick news clip from over on Seeking Alpha. Plunges, dividend cut. Okay, another thing. Again, if you're buying a stock for the dividend, you can't wait until it gets cut before you decide that you don't want to own it anymore, because it will be down 25% overnight or more, and you lose way more money in dividends in a single night than you ever would have collected over many years, okay? So dividends are not the best way to value stocks most of the time. Every now and then they can be useful in certain situations because they're a little bit more stable than earnings. But 98% of the time, dividends don't really matter very much in a stock analysis. So let's see, we have third quarter severely constrained demand environment, mostly from autos, and it degraded swiftly. So autos, we know this is another theme. I mean, I've been kind of making videos and commenting on this a lot over at the full Cyclical Investors Club service over on Seeking Alpha. Be really cautious with any auto-related stocks right now. Some of them are looking like decent values if things don't get worse. And there's a lot of them. There's a lot of them across the different industries. But I'm not convinced yet that things aren't going to get worse before they get better for the suppliers. So interest rates are still pretty high. A lot of people are tapped out already. And the prices of autos are expensive. So that's not usually a good bottom forming like recipe. So earnings came down. They were lower than expected. Revenue fell from last year. It's just bad. So you can see why the stock would fall this much. So the main thing I want to focus on is, why I didn't own this stock and how I was able to avoid owning it during this decline. Now that 25% isn't showing up here in the fast graph because it will update later tonight after the market closes for today. But, this is down. We can take a peek and see what the price is here on CNBC. I think it's 96-ish or so. 93. Actually, I can see it on the top of my screen. So it's actually all the way down to $93 a share. So if you're going to perform a basic earnings analysis for the stock, one thing we always do is look at historical earnings cyclicality. We had this giant jump in 2005. Let's just move that forward. So the first thing I want to do is go back in time on the fast graph. Fast graphs are really useful for this type of historical analysis. I do have a 25% off affiliate link for fast graphs down in the description. If you ever want to try it out, they have free trials. So this is good to look at. So what I look at are these earnings. Earnings are this dark green area here, and you can see the declines off the peak. Now this was a bad time for like auto sector too, obviously. A lot of them went bankrupt, and more of them would have gone bankrupt if they hadn't gotten help. The earnings fell, it looks like to me, exactly 50% or almost 50%. So off the peak over the course of 2 years. 50% is right at the threshold where I consider a business deeply cyclical or not. Now, in my spreadsheet, I looked and I'm treating this as moderately cyclical, but we can see that because chances are in most cases, you wouldn't expect something as bad as the financial crisis that hit autos as hard as it did, and other industries too, not just autos, manufacturing and so forth, as hard as it did, necessarily to repeat. So in my mind, I think, okay, this might be like the worst case scenario, or one of the worst case scenarios. So earnings were, we'll call it moderately to deeply cyclical, right on the borderline, but the stock price fell about 85%. So the stock price was definitely deeply cyclical. So you want to be really careful with this type of a stock. But I do think as long as you account for these earnings declines, you can run like an earnings analysis, as long as you're careful about recession risk, right? Recession risk would be, which is maybe what we're dealing with here, but you want to be careful with recession risk. But you can use earnings to value these type of businesses. So let's do that, and I'll show you what I was looking at. Now, when I started looking at all these numbers again, what it reminded me a lot of was 3M, because what we have here is we have quite a bit of debt, okay? They have as much debt, like the difference between their market cap, which is $13 billion, and their total enterprise value, which is $26 billion, is double. So one way to think about this is if you were to buy the company, and this is before today's price decline, so these are going to be lower. They're just going to look worse tomorrow. But this is going back in time to see what would have been looking at before this 25% decline that might have stopped you from buying the stock, right? So you have, if you were going to just buy the market cap of the company, be $13 billion, but if you bought the market cap and the debt and other obligations that they have, it costs twice as much. One way to think about that is, and when I'm doing valuations, this is how, like earnings valuations, this is how I think about it is, so that's about double. So it's an easy example. So if you looked at the PE going into earnings, it was 12. Well, that looks really low, right? But if you pay double for the business, that's really a 24 PE. So you have a 24 PE ratio, which is actually pretty expensive once you take into account those other obligations and debt, if you were going to buy the company. Now, like just buy it and take it private or something like that. The other thing is here, let's see. Okay, so let me shorten this graph, because it will, when it does earnings calculations, it will go to whatever you have it in the future. So this is actually a little even lower than in September, the last time I updated this, these earnings, and these are going to go even lower now too. But what I wanted to show you is the earnings growth rate during this time, if you measure from the beginning of 2015 to the end of 2024, this morning before earnings, was 6.12% for these guys. And that doesn't take into account these fluctuations here, which I do take account for, but honestly, I don't think that's the big difference that you need to watch out for. On fast graphs, this uses earnings per share, which is really good if a company's diluting shareholders, because it will automatically be taken into account. That means they're like issuing more shares into the market. But if a company's buying back shares, it will inflate this growth rate, because you have earnings per share, and if the company's buying back shares, the per share, the number of shares goes down, and that will make the earnings growth look better. The earnings per share growth will look better than the actual what earnings would be if they weren't buying the stock back. So I always like to check that as well. And what you see is, let's see where, if I can find the right button. I think Keynote is what I want. Yeah, so I cropped this off of Y charts. Give them credit for that. This is the change in shares outstanding from, it looks like maybe the beginning of 2015 or some point in 2015, same time frame as the fast graph. They bought back 28% of the company, so almost, we'll call it a quarter of the company. They stopped buying back shares in 2022. Okay, so it's worth taking a step back and thinking. Now, I'm kind of neutral on share buybacks. Some people are more for them or against them. But the main thing is that you account for them, so you realize that these guys are inflating their earnings per share buying back that much stock. That's a lot. So I try to adjust for that when I do my earnings growth rates. And usually that means I have a more conservative earnings growth rate than like a fast graph that's doing it on earnings per share. So I'll pull that up here. And you can also look sometimes at different numbers like revenue growth, which for them was 55% over that time period. So you think 55% over 10 years, that's pretty low. It's actually going to come out almost the same as my earnings growth adjustment. So I can kind of look at and see if the revenues are kind of matching up to what my adjustments are, just see if they make sense. So I have more like a little bit before, a little bit lower than 4% earnings growth. That's before this last earnings report, in which this would actually go lower because the earnings are going to come in lower than I expected for this year. So you'll see this is highlighted in yellow on my spreadsheet. I'll move my face down since people like to see everything here. That's because it's kind of dangerous when it gets in this level. Basically, during this time, we've had about 3% inflation, so this is barely above inflation. And these are all estimates kind of anyway. So effectively, the business hasn't really been growing for the past 10 years. It doesn't really have much growth, maybe a tiny bit. And what they've been doing, I didn't look at the change in their debt levels over time. It makes me, they might not have changed too much. And the reason I say that is because it was trading, like the market takes this into account, right? So you say, well, it's always been trading this cheap. So since it's been trading, this kind of quote unquote cheap for quite a while, maybe they've just been carrying similar debt loads this entire time. But the problem is when you have a company with this much debt, they raise the dividend years after year, year after year, because that's what investors wanted, right? They just cut it 95%. They also were buying back tons of stock during this time, and they were doing that instead of paying down debt, which is what they could have done. And that would have solidified their business. So when tough times come along, like they are now, it wouldn't crash the stock 25% overnight. But management liked, and I don't even know if it's the same manager. I don't know. So this isn't a comment on the current management or even much of a comment back then. But when management does a lot of, this is a general statement, they do things that will attract investors. And so investors have been clamoring for dividends when bond yields are low, so they raise the dividend. And they want to see earnings per share grow, so they bought back stock. And if you have to borrow money and buy back stock and you're one of these businesses, that's what you do. This is exactly what 3M did. And so I'll just take a look at 3M. So we can see where they peaked. They were doing the same thing, raising the dividend, crazy levels. If you looked at the stock buybacks, they were very similar actually to Celanese's here. And then it all fell apart. And then if you pile in, a couple other bad things like lawsuits and stuff for, pollution and things like that, you get creamed even more. So back then, all the dividend investors were telling me how great 3M was. And it was pretty great. But when you started looking, they weren't growing any revenues, and then they weren't growing real earnings because all this was like share buybacks from about the same time they started raising the dividend. So this is a pattern that you're going to see with management, and just, most CEOs only last like 4 years, so they want to stay there as long as they can and collect as much money as they possibly can. So that's just the way that it is. I mean, if there was CEOs that weren't doing it, they would probably get fired because earnings weren't growing fast enough, or investors didn't think the dividend was just, so it's like it's a no-win. But unless you're Warren Buffett or somebody like that can, has earned their way to do what they want. But the thing is, as an individual investor, you have to be able to just go in and run the numbers and see what the situation is. So when I see earnings growth that's below, nowadays it used to have a little bit lower threshold, but nowadays if it's below 5%, that's too low for me. And I'll put, I don't even have a buy price on here. If you watched any of my other videos on stocks, I'll have a buy price. So I just have a note that says earnings growth too slow, and it wouldn't matter how cheap it was. Okay, it doesn't matter how cheap it gets. It's down 25% today. It doesn't matter to me because the earnings growth is too slow. And when earnings growth goes from slow to negative, which we just saw revenues were negative year over year, then stocks crash. And you don't want to be in stocks that are crashing. And it's not that I avoid every single mistake when I invest. I don't. But this is one that I learned over and over that when earnings growth is slow, the danger is higher of this type of event. And I showed exactly the same thing with Huntington Ingalls last week. Exactly the same setup. Slow earnings growth once you do the right calculations and see what's really going on. And once that tilts negative, bam, you are down a lot of money. So sorry if you owned this one. I wouldn't be buying it because earnings growth is even slower now than it was before. They did stop buying back stock and they did cut the dividend, so that's good. Sometimes those can be events that are good because and maybe putting in a bottom. So I understand the temptation to want to come in and buy, and the stock might rise. I'm not saying what it will do near term, but generally the business that they're in doesn't look like it's ready to like bottom yet. So there might be a special situation where I might, if I'm feeling really, I don't know, adventurous, where I might come and buy something like this once the dividend gets cut and dividend investors leave and the dividend funds kick it out and everybody hates it. Like that can be a decent time to come in. Well, let's look at 3M. So that basically has happened with 3M so far. So that is a situation where there are investors that can try to come in and get these bottoms here. So this is what we saw with 3M. Now it's on the way back down again though. So, and for all the people that managed to pick up some stock down here, I bet it's only up like 50%. Yeah, like 60%. So I say only. I mean, I try to get big returns. So that's a good return, but you could have got it in a higher quality business that wasn't struggling. But you see they cut their dividend, right? I'm pretty sure they stopped buybacks at some point over here. But there's been people trying to pick the bottom in this stock all the way down. So it can be not only what is it lost money, it's lost time. Let's say you bought in 2019. You would have had periods where the stock was higher. Even taking into account this bump, you have a return the same as inflation over 5 years. Basically, your money did nothing, literally nothing for 5 years. And that was just trying to buy it when it was cheap after this gigantic. I mean, this is like a 50% drawdown here, probably. Let's just look. Yeah, 40%. So it's not that there couldn't be a bump, but it's challenging. It's going to still be challenging for these businesses to form a bottom and get growth going again. And that's not really what I do. Like, I want businesses that I have a history of good growth and I have an idea that good growth could continue. So I don't want to say that a person couldn't pick one of these bottoms and then make some money. Maybe even over the long term if the business really turns things around. But it's really hard for one to get the business to turn around and for two to do it in a timely manner. So this process could take a long time. And I would much rather buy a business that I know is growing. I just feel like the odds are more on my side rather than trying to kind of find a turnaround, which is really what these both are, I think, at this point. Although I think Celanese has some more cyclical issues. With the higher debt, I'm not sure what 3M has. See, they don't have nearly as much debt. Not nearly as much. So a little easier for 3M, I think, to do it than Celanese. So hopefully that helps everybody. I have a free tier on Patreon if you want to get these free videos, the S&P 500 stocks I post on YouTube for free. I have a $5 tier. You can request any stock analysis you want or feedback, and I'll get right back to you. Make a video sometimes if you want a video. If you have a request for a stock that's in the S&P 500, just put it down in the comments. I will post it. I put it on the ticker on the whiteboard behind me here, and I'll eventually make a video for you. Post it on the YouTube channel. And then I also have a $25 a month tier on Patreon where I share a weekly stock pick. And then we track the results of that. I just started it at the beginning of October. It's off to a good start. Everybody seems pretty happy so far. So usually in the middle of the week, I share a video with the best pick I can find. Sometimes my buy prices are quite low and I don't have something that I think is super cheap, but I'll find the best one that week that I can find. Thanks for watching. I'll see everybody later.